You're listening to Witham's Taxing Topics. When it rains, it pours. Tax regulations and guidance are dynamic, continually changing domestic and international financial waters. Step under Witham's umbrella to better weather the storms of trending taxing topics. We'll share the essential news and information you need to prepare for what's ahead.
Hello, everyone. Witham's excited to be back with you today, monitoring the potential expiration of the Tax Cut and Jobs Act, which obviously has been favorable for many of our family and small business entities throughout the last few years. I've brought in today some other specialists within Witham, our partner Brian Lovett and partner Brian Wallace, to help talk about this discussion and specifically focus in on how this could impact pass-through entities, including partnerships and S corporations. So, Brian, thanks for joining us today, and please introduce yourself to the crowd.
Thanks, Lynn. So, Brian Lovett here. I am a partner in our East Brunswick office, and a large portion of my practice really revolves around partnerships in real estate specifically, but a lot of partnership entities, a lot of pass-through entities. I've been with the firm for, I guess, about 16 years now, and my practice is it's been tax my entire career. Spend a lot of time talking to our clients about some of these expiring provisions and how those expiring provisions could impact their tax picture come 2026. So I'm excited to share some insight today.
Thanks, Brian. I'm Brian Wallace. I'm a tax partner in the firm's retail automotive niche, focused primarily on kind of the small business angle. A lot of S corps, operating companies, partnership, real estate entities, and the flow through to the individuals. Similar to Brian Lovett, spending a lot of time talking to clients about what's going to happen after 2025 and what tax rates and all that fun stuff looks like. So hope to add some valuable content.
Thanks, Brian. So today we are in early September. So if you can believe it or not, they say that the election cycle starts after Labor Day. I thought it started earlier than that, but apparently we're revving into high gear. We are aware, as you are probably too, that we have a pretty heated race. No clear winner for presidency appears apparent at this point in time, which obviously impacts potential federal tax reform that we could see in 2025. But why we're here today is because regardless of how the November elections shake out, it's still written within law, and we'll talk about how and why in just a second, that many tax provisions that are assisting pass-through entities, and I'll name a few, like 199A deduction, individual tax rates, AMT, those are pretty dominantly used and seen in the pass-through entity space, are going to be expiring, right? And are no longer going to be considered tax law as of 1/1/26. So it's really important that we understand, and I always stress to people, something's happening, whether it's tax reform via Democrats, tax reforms via Republicans, tax reform with both parties, or if they don't do anything, we still have significant changes happening that will require tax planning and tax strategies. So why did that occur? Unlike, not surprisingly, I should say, there is not usually a vast majority in the Senate or the House to pass bills, and it's very rare if you want a one-party bill to go through the House and the Senate and ultimately to the presidency, that you're able to do that with what you would call the proper voting structure to change law. And so often used by both sides of the aisle, President Obama and President Trump used something called the budget reconciliation process to pass. One had to do more with the Affordable Care Act, the other federal taxes, but use this type of methodology or the system that exists in Congress to make some pretty significant changes. And so what the budget reconciliation process says is Congress, right, controls the purse strings. And so they're in charge of the budget. So essentially through budget reconciliation, what they've allowed is they said, okay, we know you're not going to be able to change the law, but under budget reconciliation, we'll give you a window of time period and an amount in which you can either increase or decrease the deficit. And so way back in 2017, which for many of us feels like yesterday, we finally feel like we understand everything that's going on with the Tax Cut and Jobs Act. Believe it or not, a lot of these provisions essentially had to what we call sunset or be removed in a 10-year period, essentially because the agreement was, or the allotment, they were only allowed to allot 1.5 trillion of deficit over a 10-year period. And so while they gave us some things initially, they had to phase out eventually. And so today we're going to talk about, again, regardless of how the November election goes, the law is written for some very significant tax laws to be changing or have changed already. So our first topic we're going to talk about that I know is near and dear to a lot of your hearts out there and very relevant to all of Brian Lovett's and Brian Wallace's clients is bonus depreciation. So one of the actual tax policies that isn't due to sunset, but has already been adjusting over the time period starting in 2023 is essentially bonus depreciation. We recently just had a webinar where we asked our clients, what is bonus depreciation this for the 2024 taxable year? And many were still saying it's 100% because we're so used to it being 100%. But actually, bonus depreciation dropped last year to 80%. And the current 2024 tax year is 60% and will continue to decrease to ultimately to 0% and be ultimately phased out altogether based on the way the law is written today. And so I wanted to ask Brian Lovett and Brian Wallace, who have many clients who are in this space, what are they doing? What is the reaction, first of all, in understanding and realizing the significant decline that will be occurring now and in the future, and any tax planning ideas or strategies that have been being reevaluated that might have been put in a dusty box for a long time when 100% bonus depreciation still existed?
Yeah, I mean, I would start by saying they're frustrated, right? I mean, bonus depreciation has been something that's been around since 2001. And largely in my experience, clients seem to have kind of budgeted it in, right? If I'm making these improvements or I'm making these expenditures, they expect more than, that maker's depreciation table tells them for those short-lived assets. And largely, as you said, like 2017, when this law was passed, since 2018, we've had 100% bonus depreciation for 2018 to 2022. And prior to that, it was high percentages, sometimes 100% based on how the economy was going. So, I think that a lot of the folks that I talk to have really kind of baked in this expectation that for certain types of improvements, they're going to get something very close to 100% deduction in the year they do the improvement. And without any further legislation, that is rapidly changing. So I think there's a little bit of, I don't want to say shock, but I think to your point, a lot of folks still operate as if it's 100%, even though currently in this year it's 60%. Brian, I'll give you some time. I don't know what you're seeing on your side.
I mean, I would say it's similar on my end. I think we had a little bit of a glimmer of hope with the legislation that was sort of presented earlier in the year where potentially 100% bonus was going to get extended. So, everybody was very optimistic about that. And, it turns out it really hasn't gone anywhere. And we're kind of in this position now. Spend a lot of time talking to them about it. Are there expenditures that they can accelerate, capital items that they want to move forward a little bit on, just to try to get that in on a year where they get a better bang for their buck? But yeah, I mean, right now it's slowly becoming acceptance, right? Not happy about it at all, but it kind of is what it is. Everybody's gotten used to it. You're right. I still have those same conversations. Oh, you take 100% bonus on this? We can take bonus on it. It's not 100%.
I think, the two things that I think I'm seeing more of, as we try to deal with this phase out and understanding that the first year recovery may not be what we thought it was. I mean, there's really two things we're talking to people about on a regular basis. One is kind of dusting off the tangible property regs from 2012 and being really intentional around what is my capitalization policy? What type of items do I need to capitalize and depreciate versus what can I expense as a repair or a maintenance item? Look at the safe harbors that came out as far as routine maintenance is concerned around for your properties. Is there any way that I could take a position that this is not an asset I need to capitalize and depreciate, but that I can expense in the year I incur it under those tangible property regs? Does it rise to the level of a betterment, an adaptation, or a restoration that is sufficient to require capitalization under those rules that were given back in 2012? So I think it was 2012, 2014. I don't know, it feels like forever ago. But that is one area where we're really, and it has ancillary benefit beyond just the bonus depreciation rules, because if you expense an item and you can take a position that it's repair and maintenance item and you can expense it, we don't need to worry about depreciation recapture on the disposal of that item and things like that. So it keeps our fixed asset schedules clean. It gets that number through our P&L the same way that 100% bonus depreciation would. So I think 2017 to 2022, I don't want to say it was lazy, but there wasn't as much of a motivation to really analyze those expenses the same way. Because if I hang it up and I capitalize it, I can depreciate 100% of it. Now that phase out happens and is happening to a greater degree in the coming tax years, I think there's a renewed focus on what do those tangible property regs say and what do we need to do to take a position to depreciate or to deduct instead of depreciate. The other area, and it's not so great in real estate, we have a lot of structural issues because of the trust implications, but Section 179 deductions. Brian, that's probably something you deal with more. I don't know if you want to talk about that.
Yeah, I would say that certainly is. And in the dealership world, without getting into the kind of the nuances of dealership accounting and floor plan interest and the inability to take bonus depreciation potentially because of the interest deduction limitation rules, we've had to rely on it on Section 179 a little bit more recently. Doesn't work for our larger dealership groups, but for these one-off or two-store groups, we can usually get away with relying on the benefits of Section 179 to take a full deduction in the year. Not as good as or as powerful as 100% bonus, but it's an option that we've been kind of relying on more and more.
And I think that for both of those, it's a really important point that to the extent you have multiple state filings, right, that if it's a 179 expense, generally is respected by the state. If it's an expense, right, and not a capitalization, that's bonused, generally respected by the state. So I agree with both comments that, in the past, it's been kind of pushed aside because of 100%, but that detailed review and that need to scour those expenditures is going to become increasingly important as the bonus depreciation percentage drops. So.
Yep. I mean, that's really it. I think on the real estate side, we see a little bit more challenge with 179. Obviously, with some of the requirements, it requires profit. If you've done some estate planning and you have trusts in your ownership structure, trusts are not allowed to necessarily take that deduction. So it requires some complicated special allocations and things like that. But and the other thing I would say is even without bonus depreciation, and maybe more without bonus depreciation, analyzing cost segregation and getting things into the proper buckets for depreciation so that you're not leaving things that could be a 5 or a 7 year asset in a 15 year or a 27 and a half year bucket. Really making sure that we're being intentional about what asset categories we're placing in service. Even without bonus depreciation, we can get our recovery as fast as possible.
Putting my clean energy cap on too, I'd be remiss if I didn't mention 179D, which there is no limitation on. But if you are doing significant improvements to what they call your envelope, your windows, your doors, as well as your HVAC or your lighting, that's another way that we potentially can accelerate that deduction for the client. So all great points. And I think the main item I would also like to point out that sometimes is forgetful is tax law isn't put out there necessarily to represent a fair financial statement, right? That's US GAAP. Tax law is put out there to incentivize taxpayers to perform certain transactions, right? And so by providing 100% bonus depreciation, as Brian discussed earlier, it was 50. If the economy was a little slow, it might have been moved to 100%, was really to stir the economy for large capital investments for our businesses and growth. And so that obviously could have an impact on how modern, but how much growth we see if we're pulling back on those types of investments. So that was a great discussion. I think our next discussion is probably the most painful discussion we're going to have. It's surrounding something that's near and dear to all of our hearts in the pass-through area. It's referred to as the 199A deduction. You might hear somebody say the QBI deduction, but essentially it's a deduction approximately 20% for certain pass-through entity businesses. That was really put into place for parity with the dramatic decrease in the corporate tax rate. And if you've heard me speak before, you've probably heard me talk about this because this is my soapbox. I think I often tell people that the amount of the congressional leaders that were there who passed the Tax Cut and Jobs Act there are a few left there now when we're looking at federal tax reform. So I always think it's important to understand the why, like that, the fact that many said TCJA would not have passed unless it had 199A business deduction. And now we might be hearing rumors from some people saying they think 199A is a tax break for the rich or is something that's being manipulated. So I bring that up to remind us of the reasoning why. So back in the olden days, which I can't believe 2017 was the olden days, but essentially we had a corporate tax rate at 35% and we dropped it to 21%, right? Huge, very significant drop. What we had for an individual tax rate was 39.6%, and we dropped it to 37%. So many pass-through entities, which, if you're not familiar, are the bread and butter of America, right? There's more pass-through entities in the U.S. by far than C corporations. Pass-through entities actually employ more people than C corporations. They have an impact on our economy. They raised their hand and said, wait a minute. So they received a 14% tax rate drop, but we're only receiving essentially 2 to 3%. That doesn't seem right, and kind of tilted their heads and said, no, let's talk about this. So essentially, through this conversation, they came up with, again, doesn't apply necessarily to everyone, but for a bulk of pass-through entities, what you're allowed to do is create a 20% fictitious deduction. So essentially, if I have trade or business income from my pass-through, that's $100. And let's say, okay, I'm going to qualify for 199A, they're going to give you a $20 deduction. So now you're only paying a tax on taxable income at 80 instead of the 100. And by applying the highest tax rate, that brought pass-through entity owners to be around a 30% tax rate, which was trying to create parity. I know some of you might say, well, that's not parity. There's still a 9% difference, but there is a difference between how pass-through entities only pay tax once generally and C corporations pay tax twice. So it is real. I always like to point out it is definitely on the table that 199A could go away. So, I mean, how could you not talk about that on a pass-through entity broadcast? But let's hear how that's impacting both Brian Wallace and Brian Lovett's clients, and understand more. If we had a buzzer, an alarm, or a tornado warning, we would be using it right now to say this is a really important item that you need to follow.
Yeah, maybe I'll jump in first this time instead of letting Brian Lovett do all the talking.
Go ahead.
Yeah, I mean, I think the key here is entity structure, right? We looked at it when TCJA was passed and everybody saw that 21% tax rate. We spent a lot of time with our clients talking to them about, does a C Corp make sense? And we ran a ton of analysis, and of all my clients, 0 switched to C corporation, because when you factored in the double taxation structure with the C corporation and the benefit that they were getting from the lower 37% maximum individual rate and the 20% QBI deduction, still in a better position, especially if there was a potential exit of the business at any time in the future. And so I have a feeling if, we're going to be doing these analyses again, and we might come up with some different conclusions, especially if people are looking to remain in business for an extended period of time. The C Corp structure allows you to build up some working capital just because of that lower tax rate. But as far as planning, I can say again, we talk about accelerating income, which is just such a weird concept from a tax planning perspective, because our whole goal is to defer income and pay taxes tomorrow instead of today. I know I don't want to steal everything, so Brian, I'm sure you've got plenty to weigh in on. And
no, I mean, I think that choice of entity discussion is a very interesting discussion to have with people when we start to talk about this. But I think that kind of makes this binary choice between, do we do it this way or do we do it that way, right? And pass-through entities, partnerships, and I can speak largely from the real estate perspective. for years we've been telling people don't put real estate in a C corporation. The flexibility associated with subchapter K and the ability to be taxed as a partnership, and you want to do estate planning, you want to part ways with your partner and distribute property from your partnership. We have a lot of carryover basis rules that make that possible in partnership solution, where if we take that real estate company and we make it a C corporation, and now we want to distribute out a piece of property that's appreciated in value and it's been owned for 20, 30, 40 years, and we want to distribute it out. Well, under the corporate provisions, we have to first recognize that built-in gain and pay tax on it, even with a non-cash transaction, right? So it's a hypothetical sale, a markup to fair value, a taxable transaction to the corporation, and there's no cash there to pay that tax. And when you talk about real estate that has been owned for years and generations, that is a very, very costly decision. So we start to, we get into this, this choice of entity discussion, and we try to isolate it to just a tax analysis. That doesn't give us the whole story. So it adds layers of complexity to this decision. And the other thing that I see a lot when I talk about this, when we look at this with folks, and we've been trying to raise that tornado warning, Lynn, and say, hey, this is a real thing, is for a lot of them, it's not necessarily the comparison to, well, if I was a C Corp, what would my tax bill be? And if I'm a pass-through, what would my tax bill be? For 5 years, they've benefited from a lower tax bill. And now through expiration of this provision, that tax goes right back up again. And, I think to understand the full cost and everything, it's going to be really interesting to see where this goes, because obviously, with all the proposals that are floating out there now with the presidential candidates, would the corporate rate, will it stay at 21%? Well, if it doesn't stay at 21%, how beneficial, how much do we need this 199A deduction? So on its face, isolated to where we are right now, I would call it a hidden tax increase that is creeping up on people. And people have, much like bonus depreciation, right? It's become part of the calculus now, where, in effect, I have passed through income and I'm going to pay tax. I'm eligible for the maximum benefit. I'm going to pay tax on 80% of that number because I'm eligible for the maximum benefit, and it's part of the code now. And by operation of law, 2 years from now, they're going to pay tax on 100% of the income again. And whether that rate is 39% or 37% is relatively immaterial. You're still paying tax on 20% more income that you weren't paying tax on today.
So,
so it's
I think you both nailed two things. So I'm just going to reiterate them. One is, don't change anything yet, right? We don't know what's going to happen. Like, yes, if TCJA expires, 199 is going away. And if that's all that expires, technically the C corporation tax rate is staying at 21%. In reality, do we really think the C corporation tax rate is going to stay at 21% if there's federal tax reform? We don't know, right? Democrats are optimizing or trying to increase it to 28% at the very least. And while Republicans have even noted bringing it down to 20%. So that's the one thing. Everybody says, well, what should I be doing now? And that's the worst in business, right? And the worst for the economy, where we have to say, just freeze for a second, handle your business as it exists today, because we can't talk you through what's going to occur in the tax world until at least after the November elections, or have a better crystal ball, shining at us. The other big item that I like to point out that I think is so important, and it was touched upon, but please don't do this analysis on a year-by-year basis. Please do this analysis with the understanding of your exit strategy, right? Because there are so many implications of coming into a C Corp that very much could be challenging as you move forward to exit or transition your business, that unfortunately, without good tax advisors, aren't spoken about often, and unfortunately could bring up some big surprises at the end of your ownership of your company or transition of your company, that are unexpected and obviously could have been avoidable. The only thing I'm going to give is a brief example, and we'll talk about bonus depreciation, refer back to it in a second. But running the numbers, assuming you're at the highest effective tax rate in 2024, if you make $1 million of pass-through income and you get a $200,000 20% deduction, that means you'll have $800,000 of taxable income, and you're going to be around, as we've already discussed, a 29.6 at 30% effective tax rate. In 2026, same exact operations, $1 million, no longer have the deduction. Your tax rate is going to go up to around 40%, your effective tax rate. And so you're essentially seeing a cash flow outflow increase of about 33%. So it's really going to be important. We don't want anyone to be surprised. This is a very important issue. The only other item before we jump that I want to point out on this particular issue is there also seems to be a misnomer, and Brian's, I would love your client factual situation on this. That when you talk to people, when they say that pass-through entity gave you $1 million of taxable income, like in my example, there's an assumption amongst many who are in this world who say, well, that means that Brian personally, right, that individual who is a partner in the partnership or a shareholder in the shareholder, has $1 million in their bank account, right? That all that money has been distributed and they have access to it, and so they should pay higher taxes. In reality, is that what you see when you're doing a lot of your partnership and your S corporation tax returns, that the cash distribution matches the taxable income, or does it look like something else?
Yeah, I mean, I would say from my perspective, like on the dealership side, we're seeing a lot of capital investment, right? So with the bonus depreciation rules, there's some benefits to keeping the cash inside the business, using it to reinvest in the business, hire additional people. So they're not typically, what I see is distributions to pay the taxes. Right. So a lot of my clients are S corporations. They're already taking a salary because there are requirements for S owners to take a reasonable compensation. So they're taking a salary and they're taking distributions to pay their taxes. There may be years when they do take additional distributions when cash flow allows that, when there's excess cash in the business. I'm sure on the real estate side, taxable income and cash flow are so not related. Brian can speak to that, I think.
Yeah. I mean, I would say that very rarely in my practice at all do I see pass-through entity partnerships where taxable income allocations match distributions, right? And, a lot of it in the real estate space, I would say a lot of it depends on the life cycle. A lot of it depends on the level of financing. Right. If we're talking about a new project that requires ongoing maintenance, they're trying to stabilize a building and there's a lot of need for capital inside there to fit up tenant space and to induce tenants to come into the building. That's a situation where there's a lot of outflow of dollars that wind up on the balance sheet that are depreciated and amortized over time. So there may be taxable income, but there's not excess of cash to distribute to the members. Later on in the life cycle where the debt is paid off and, then you're seeing a stabilized building, maybe we flip the other way. So I think it definitely does depend on the life cycle of the business. But in my experience, no, Lynn, to your point, there is an awful lot more of, there's no way I made this much money. I don't have any dollars left at the end of the year. How am I paying tax on this much? Kind of sticker shock associated with that, especially early on in the life cycle. And, you're seeing, to Brian's point, operating agreements that provide for tax distribution provisions to investors so that if you're allocated taxable income, you're given some cash to make yourself whole from the cash outflow. And so for partnerships with those kind of models where it's, annual or quarterly distributions to cover tax bills over the next 2 years without further legislation, they're going to see the need for that cash flow to be a little bit higher because there may not be this 20% benefit that's available for those shareholders.
Yeah, so I think all great. And so this is, I know for anybody who has a pass-through entity, they know that is factually true, but it really highlights the difference. If I have a W-2 and I got paid $1 million, that is truly different and distinct from I'm running a business and I had taxable income flow to me of $1 million. And I think it's so important to understand, especially as you pointed out, in the beginning cycle of these new businesses, that's far more challenging to find that cash to pay that tax bill. And they are two separate and distinctive analysis, I would say. And the other thing, so we're going to start talking about another topic, but I want to make sure that you understand that everything we talked about with 199A, like the example I gave you, was as if my taxable income stayed the same, right? And so I always like to point out to people that I can guarantee your taxable income isn't going to stay the same regardless of your operations, right? Because we're seeing bonus depreciation drop. We're seeing the interest expense and limitation rules tighten. We're seeing 174 R&E capitalization, which we won't talk about today, but is extremely painful. And so not only $1 million that you maybe calculated in 2024 might be, I'm just throwing out numbers, depending on your facts and circumstances, might be 1.5 million. And then you're applying, right, an effective tax rate of 30% versus 40%. So really, really important to understand that there's two different areas that's becoming bigger for the IRS to potentially tax. The other thing I wanted to talk about today, after we talked about bonus and we talked about the QBI deduction, is just the individual tax rates that are happening, right, under the TCJA sunsetting provisions. So a lot of people like to highlight, the brackets are shifting. And if we had, if we knew you were seeing a slide, we'd show you. But it really is that many people will get into higher brackets sooner. And that the bracket shift, the highest effective tax rate will go from 37 to 39.6%. And so that's just another, right, rate hike, right? So essentially now the 20% deduction goes away. The maximum tax rate used to be 37. Now it's the 20% goes away and the maximum tax rate is 39.6. So I don't know if there's much more to say than what I just said, but I guess to both Brian Lovett and Brian Wallace, do you find that your clients are aware of it? And do you think, I think the bigger question is all these tax increases, how could it potentially impact their businesses?
Yeah, I mean, I would say I don't get into the nitty gritty of like the specifics of the tax bracket shift and all that stuff. Speaking, to my clients more general terms, I find that they don't necessarily want to know that like the tax bracket went from X dollars to Y dollars. They just kind of want to know the nuts and bolts, and the fact that the maximum rate went would go from 37 to 39.6. It's impactful, right? And then all these other things that you talked about, and throw in higher interest rates, which makes again the interest deduction limitations more impactful because now there's potentially more non-deductible interest, but you're still paying that interest, so it's still taking down your free cash flow that would be available to pay taxes or grow the business or bring in more employees and stuff. So, it's the opposite of the elation we were experiencing in 2018 when all these beneficial changes came through, right? We were like, wow, this is great. This is going to help this, and this. And now we're, have to unwind it and go, all right, well, all those great things, they're going to unwind. And it's going to be, business as usual, back to the old.
Yeah.
Yeah, I mean, I think that's the biggest issue, right? I think that where we talk about these business provisions and we talk some of these things about pass-through entities and how they're impacted, but I think that, to keep the focus on the fact that the ultimate tax here is paid by the individual taxpayer owners of these entities. And in large part, they're going to be looking to the entity for that cash flow. And it's not just the 2% increase or 2.5% increase on the highest rate. Lynn, I think what you talked about there is the change in the brackets, right? And the reversion to the brackets prior to TCJA, which puts, more of the income at higher brackets, even though the top rate doesn't move much. Those businesses that are, to Brian's point, maybe paying higher interest rates, whether they can deduct it or not, the dollars are still going out on higher interest rates. And trying to reinvest in their businesses and hire more people are now looking at the end of the year and saying, okay, and now we need to account for this tax bill that, 2 years ago was so substantially lower, to your point with 199A, 30% just based on that provision alone, or 33% on that provision alone. And then you throw in the higher rates on top of that. It's just a confluence of events that I think if we had this conversation in 2017, late 17 or early 18, when TCJA was passed, we looked at it and said, this is great. And, we kind of got spoiled by extender bills and things like that would never let some of these things expire. So I think, the realization that, we should start to think about and plan for, and I think it's hard to plan for it because you just don't know what it's going to be. But the conversation should certainly be happening now because, it's the individual owners of these entities who are going to be accountable for the taxes, whether they can get that from the business or for other assets that they may have in their portfolio. The dollars are going to need to be paid.
Yeah. So those are all great points. So I think the one point that I'd like to reiterate is that it's not just that the 37% tax rate is going to 39.6%, right? When we're just talking about the individual tax rates, it's about the bracketing And we're going to see a significant shift when we start going into TCJA expiration years, that the 39.6% rate is going to apply quite sooner. And the 33% rate, as opposed to 24 or 32%, is going to apply for a much wider bracket, meaning that those of you who might be getting taxed at 24% today would get taxed at, some of your income would get taxed at 33% under the TCJA expiring provisions. So again, this is on top of, right, our taxable base being broadened, individual income tax rates going up, and potential removal of 199A, or actual removal of 199A if all that happens as the TCJA sunsets. And so it's really important, it's not so easy to just say, I'm going to take my taxable income and now multiply it against the new rates. There's a lot of moving pieces in there here. And there's a lot of great planning ideas from your Witham professionals like Brian Lovett and Brian Wallace to help you understand when to buy, when not to buy, when to invest, how am I going to have the cash to pay for these additional taxes? All of those conversations should start rolling, obviously, close to year end or after the elections, when we have a little bit better idea of where we could be going. So the last thing I want to talk about is individual AMT. And this one, I'm going to give a very basic example, but essentially, for those of you who say AMT what, I just know years ago I used to be in it and I'm not in it anymore. I would say that's true. As part of the Tax Cut and Jobs Act, there was a substantial increase in the amount of income that you could have before being applied this alternative minimum tax, or this tax on top of your regular tax liability. And so before the TCJA, that exemption was around $161,000. The phase out threshold jumped to about 1.1 million, almost 1.2 million after the TCJA. And so what that allowed many people to do is to say, okay, AMT doesn't apply to me. So a lot of you might say, well, what's AMT? So AMT generally is your taxable income calculation, but they add back certain things where they say, we want to make sure you're paying at least this amount of money when we don't include things like state and local income taxes that you may have deducted on your Schedule A. And so we have really seen quite a significant decline since the TCJA has passed, with people incurring AMT. But they do anticipate, I think they said up to 8.2 million taxpayers being subject to AMT again if TCJA should sunset. So put on your thinking caps. I know we still deal with AMT for some of our clients, but what do you think your clients are prepared to talk about AMT? And more importantly, I'm going to push this question out to Brian Wallace and Brian Lovett, is what happens with that PTET payment I've been paying as a pass-through entity? Does that go away? So I'm going to throw that out to the group for some further discussion.
So I would say, AMT is not something that my clients want to talk about. It's not something they like talking about before TCJA. So it's certainly not going to be a fun discussion after TCJA. And it's largely, I don't want to say, a lot of people just don't understand it or don't understand why it exists, right? But I do think it's a real discussion that needs to happen right now. Largely, my individual clients who are paying AMT are those with large investments where they end up paying that beneficial capital gains rate, somebody with large capital gains. And so the vast majority of their individual income is at that lower capital gains rate. And so when we go through the AMT calculation, they are being pushed a little bit into AMT depending on the percentage of income that's taxable at that capital gains rate. Because, for the most part, our everyday clients are not seeing the large add backs for things like state and local income taxes to these jurisdictions with high tax rates like New Jersey and New York. That does come back, obviously with the change in the exemption and then the expiration of the SALT limitation. We are going to be seeing a lot more clients into that AMT space and need to explain that a lot more. And I mean, the PTET question is a really interesting one. And Brian, I don't know if you want to talk about that a little bit, but I mean, I think, where possible, that may be a nice plan for AMT problems.
Yeah, I think, and we chatted about this a little bit before the call. The fact that the businesses can make this state tax payments on behalf of the individual partners or shareholders and get that deduction at the entity level, passing out a lower federal taxable income number. That those state taxes don't become an add back for AMT purposes, and when those state taxes are paid at the individual level, they do become an add back. While they're deductible on your Schedule A, they do become an add back, and historically, that's typically what pushed our kind of everyday taxpayer into AMT, was state taxes. And so, to the extent that the pass-through entity taxes remain available after the potential sunset, certainly seems like I don't want to say a no-brainer, but it certainly seems like a strategy we would look to encourage with our clients.
Yeah. And I'm just going to summarize it that while many of us, especially I think people on the East and the West Coast, are going to be very excited if the SALT cap should be lifted, right? We haven't seen that in a long time. And the cost of living tends to be higher in those areas. Don't jump and say, well, that's what I'm going to do now and stop paying my PTET. Because if you continue with your pass-through entity tax at your local state level, you still might receive some federal benefit by either decreasing or avoiding the alternative minimum tax. Unfortunately, I have bad news for all my friends out in California. I should not be laughing, but they thought of this in California, and they said that the California PTET regime would be done at the same time the TCJA expires. For New York and New Jersey, we didn't see such similar language. Doesn't mean that they wouldn't potentially become one, but essentially for New York and New Jersey, we would expect, even if the SALT cap went away due to the TCJA expiring, that indeed we could still be involved in PTET regimes like New Jersey BATE and the New York pass-through entity tax. So again, something to talk to your advisor out and about, and where you are through state nexus will be important. Before wrapping up the discussion, I think we'd be remiss if we didn't talk a little bit about qualified opportunity zones and the importance of understanding that in 2024, right, we're sitting here waiting for the election. Some people have a very aggressive schedule saying that we would see tax return in the first quarter of 2025. Not all believe that could potentially occur, but sometime in 2025, we may see federal tax reform. And I just want to point out that within that federal tax reform, there could be movement in the capital gains rates. We don't know, right? But I would point out that there could be, and there's a large significant event happening in 2026, right, Brian, if you're involved in qualified opportunity businesses. Do you want to talk about that?
Yeah. So, I think, just a quick overview, 30,000 foot, the Qualified Opportunity Zone program was introduced as part of the TCJA, and it was a nice opportunity for taxpayers to potentially unwind transactions, recognize gains that have been baked into the market, right? The goal was to say, hey, we have a lot of taxpayers with a lot of built-in gains, and we would like to incentivize them, to Lynn's earlier point, right? A lot of these tax provisions are designed around incentivizing behavior. We want to incentivize investors to liquidate their positions, recognize their built-in capital gains, but give them an opportunity to defer those capital gains in the future, so long as they commit to long-term sustained development into these designated qualified opportunity zones, which were picked by all the chief executives of the various states. And so that program would allow deferral of a long-term capital, long or short-term capital gain, of a capital gain into a qualified opportunity fund, with a provision written into the law that said, whenever you do this, and there's a lot of complexity to it, but when you do it, 2018, 2020, 2022, we're going to allow you to defer that initial capital gain, defer recognition until 2026. And on December 31st, 2026, assuming you stay remaining invested in this fund, you need to recognize all or a portion, depending on the law and how long you've been in, of that deferred capital gain on your 2026 tax return. Now, again, if you had sold your asset in 2019 and the maximum capital gains rate was 20%, you would have paid 20% in 2019. Instead, you defer into an opportunity zone, you're going to pay tax on that capital gain in 2026. But the rub, and where Lynn was going there, is that you're going to pay it at the rate of tax applicable to that gain, whether it's long or short term, in 2026, right? So you cannot use this opportunity zone program to turn a short-term capital gain into a long-term gain. If you deferred short-term gains, they're going to be taxable as short-term gains on your 26 return. If you deferred long-term gains, you're going to be taxable as long-term gains on your 2026 tax return. And to Lynn's point, if the ordinary income rate goes up to 39.6% and those brackets reset in 26, when you have a short-term gain that you have to pick up that you deferred under this opportunity zone program, it's going to cost you more in $26 than it would have had you recognized it in the year, that you generated the gain. So there is potential for some of these deferred capital gains, and there's a fair amount of dollars sitting deferred related to qualified opportunity zones that are subject to risk now, rate risk, depending on what happens over the next few years.
Great. And it's a great point. I'd say, similar like kind exchanges, any type of deferral provision to the extent your deferral period ends, right? With new tax law, it's the tax law that exists at the time in which it ends that is applicable. So all great discussion. Again, I want to recap and make sure everybody's aware that today we just talked about, it was not about what the agendas are of the Democratic or Republican parties for tax policy. It was just telling you if nothing happens, which we have been known to see out of Congress sometimes, the people not being able to agree, how would we be impacted? And the TCJA provisions we talked about today indeed will expire regardless if federal tax reform does or doesn't take place. We'll continue this discussion. Another big area to be aware of is there is significant TCJA changes happening in the estate and gift planning sector as well. So we're going to talk about that completely separate in our next podcast. Before we start rolling into, now we need to know what could happen, how the race might go, and what type of tax policies might we see brought up or discussed by each political party, depending on who might win the race. We're very excited to be with you. We're hoping that these are useful to you and making sure that you are bringing all these questions that have popped up today and on our other podcasts about how best to move forward with your advisors. I would remind everyone, if you haven't already, we are hosting 2 events, one in New Jersey on September 23rd, and one in New York City on September 24th. We're going to be bringing up some of our DC affiliates, and we're going to be talking more about what's going on in DC and what we could foresee occurring over the next 3 months. If you're in those areas, please register. We'd love to see you live. And without further ado, I'll ask Brian Lovett or Brian Wallace, any other thoughts that you'd like to share, or do you think you've shared enough knowledge? They're silent, so they must have shared.
Listen,
right.
I got nothing other than don't overreact. Think and plan and understand what's going on. But certainly, while it's a time for planning and thinking, it may not necessarily be a time for running out and doing anything irreversible because, while there's a lot of volatility there and we're not really sure where this lands. But it's important to understand where it may go.
Great advice. All right. Well, thanks for everyone joining us, and we'll talk to you in our next podcast. We'll talk about how the TCJA expiring provisions will impact high net worth individuals and estate planning. Take care.
You've been listening to Witham's Tax and Topics. Contact us with your feedback or suggestions for future podcast topics. Visit www.witham.com for additional information. Send an email to info@witham.com or follow us on Facebook, Instagram, or Twitter @WithamCPA. Thank you for listening.